Living in Europe might seem ideal to some people and can also be very appealing, especially if you're coming from a Western country and you want to be in a similar cultural environment and in an English-speaking area. One thing to consider when thinking about moving to Europe are definitely taxes, as Europe is not known for low taxes. However, certain countries do provide special programs or regimes that can help alleviate your tax burden, and that is what we're going to discuss here today. My name is Jelena. I'm a strategy manager here at Nomad Capitalist, and we help 7 and 8-figure entrepreneurs go where they're treated best. And if you want to learn more about Nomad Capitalist Live, go to nomadcapitalist.com and subscribe to our newsletter. Living full-time in Europe does not have to be burdensome or that expensive tax-wise if you find and settle in a country that offers certain tax benefits. If we're speaking strictly about European Union, best options that will offer a non-domiciled tax regime are definitely Malta, Ireland, and Cyprus. So what is a non-domiciled regime? This regime revolves around you being considered as a non-domiciled tax resident in a certain country. You as an individual can never be without a domicile, and generally, you are considered to be domiciled in the country of your nationality and in the country in which you spent the greater part of your life. And that is known as domicile of origin. Once you have reached the age of maturity, or 18 years of age, domicile of origin can be abandoned and a domicile of choice can be acquired. In this situation, factors of physical presence and intention are important. The concept of domicile varies in some small details from country to country, so it is important to take into account the laws surrounding that in the country that you're considering. So we can go one by one. First of all is Malta. Understanding the meaning of domicile and residence under the Maltese law is generally essential to understand the tax planning opportunities that are arising out of the taxation of non-dom residents in Malta. In Malta, residence and domicile are two distinct legal concepts which are defined differently, and therefore they have different legal consequences from a tax perspective. According to Maltese law, individuals who are living full-time in Malta and consider Malta as their permanent home are considered domiciled in Malta. However, home in this context can refer to the place where a person belongs and does imply stronger ties with the country than residence does. Domicile is truly where your vital interests are located, so it is important to know that according to the Maltese law, domicile does not depend on nationality, which means that someone can acquire Maltese citizenship by investment and could still claim the non-dom status and not pay full regular taxes in Malta. Furthermore, Maltese law also establishes that a person who takes up residence in a country, even for a long or indefinite period, does not generally acquire domicile in that country if you have the intention of returning eventually someday to your country of origin, or you have the intention of settling somewhere else in another country at a future date, as you cannot generally have more than one domicile at a time. So that is a catch with these non-domicile programs. You have to show very strong proof that you are not domiciled in the country and definitely support the intent to not become domiciled. Now, if you qualify for Maltese non-dom tax regime, the remittance basis of taxation applies. Under the remittance-based taxation system, all income arising in Malta is subject to tax, regardless of where it's received, and income arising outside Malta is subject to Maltese tax only if and to the extent that you remit it and receive it in Malta. However, there is one exemption where capital gains arising outside of Malta are not subject to tax even if they are received in Malta, which is kind of a perk that Malta offers. And in addition to these tax obligations, there also exists a minimum tax liability for non-domiciled individuals, which is about 5,000 euros per year. So you have to pay that each year. Now, one downside to Malta is that using this regime, you will have to live in Malta for 6 months per year. Malta does offer another program for tax residents where you do not have to live for 6 months to be considered a tax resident, but the price point for qualifying is definitely much higher than it is for this regime. Now, this non-domiciled tax regime presents a tremendous opportunity for those who wish to live in the European Union under a tax-friendly regime. If structured properly, you might only be liable for the fixed amount of 5,000 euros per year. And this is especially true for people who make most of their money through stocks, bonds, property, commodities, or cryptocurrency as well. The second country we have here is Ireland. Just as it is in the case of Malta, Ireland defines residency domicile as two distinct legal concepts, meaning that an individual can be an Irish resident without necessarily being domiciled in Ireland. For Ireland, a domicile implies a strong link to the country, and an individual who is domiciled in Ireland has the intention of remaining indefinitely in Ireland and has his center of vital interest in Ireland. In other words, someone domiciled in Ireland has his permanent home in Ireland. For legal purposes in Ireland, the term home goes far beyond the property that serves as a primary residence, and a home implies a sense of belonging, a true link between an individual and his homeland. An individual who is considered to be an Irish resident without being domiciled in Ireland is taxed in Ireland on Irish-sourced income or gains and proceeds of any income that is remitted to Ireland. In this situation, Ireland is similar to Malta, where the remittance basis of taxation applies. And that means that people who are non-domiciled in Ireland are taxable only on foreign income that is brought into Ireland. Obviously, all Irish income or gains remain subject to full Irish taxation. However, Ireland is also much more strict when it comes to what they consider remitted funds than Malta is. So, for instance, the use of a foreign credit card to purchase goods in the country is considered a remittance of funds. In addition to that, capital gains that are derived from foreign sources are fully taxable when remitted to Ireland, which is not the case in Malta. So, Ireland in general has a bit unfriendlier tax policies than Malta. And Ireland also requires that individuals who claim non-dom status are able to prove that they have a foreign domicile. And in this sense, it is strongly recommended that a non-domiciled tax resident of Ireland maintains some kind of the following in order to justify the non-dom status, should it ever be challenged. So some of the things that you should have maybe prepared is a last will or testament that is prepared in the country of your foreign domicile. Then strong personal ties with the country of foreign domicile, such as frequent visits to family and friends, or memberships in business organization or clubs in that country where you came from. And also economic ties with the country of foreign domicile, such as investments, interests, business dealings, or similar items. In addition to that, it is also necessary for people who claim non-dom status in Ireland to show that they have the intention to return to the country of foreign domicile. In other words, this means that although a non-dom individual may be living in Ireland at the moment, that person must be able to identify a point in time when they plan to return to their home country. Some of the examples of that would be, let's say, a spouse's death, for example, if the spouse is not with you, retirement, graduation of your kids or grandkids, or a change of the tax regime or otherwise political regime in your home country. Now, taking into consideration the remittance tax system, Ireland has a concept that is known as clean capital, meaning that you can get the money into Ireland for living by basically ring-fencing the pre-Irish capital. So as long as your money was obtained before you became an Irish non-dom tax resident, you can ring-fence it and bring that clean capital to Ireland before becoming a non-dom, at which point it will not be taxable. In addition to that, just like Malta, if you want to qualify for this program in Ireland, you will have to spend at least 183 days per year in Ireland. Now, the last country we have here is Cyprus. And when you look at Cyprus, it will appear that it has the most tax-friendly non-dom program, even more than Malta. Cyprus's non-dom status for tax purposes lasts for a maximum of 17 years. And people who have this status are fully exempt from paying taxes on both dividends and interest, regardless of whether or not they are foreign sourced. While Ireland and Malta use remittance-based taxation for non-doms and foreign capital gains are fully exempt in Malta, Cyprus takes a bit different approach and much simpler, where dividends and interest are tax-free for people who have the non-dom status, regardless of whether they're Cypriot sourced or they're foreign sourced. Capital gains, other than those that are arising from the sale of immovable property in Cyprus, are also tax-exempt in Cyprus. Now, this extremely favorable tax treatment, coupled with an extremely low presence requirement for tax purposes of only 60 days to obtain it and maintain tax residence in Cyprus, makes the Cypriot program the most favorable for digital nomads and permanent travelers who want to utilize the trifecta approach. Now, besides the favorable tax regime under the non-dom in Cyprus, there's also 100% exemption on salaries that are received for work done outside of Cyprus for more than 90 days in a tax year to a non-Cypriot employer. And there's also no inheritance or gift tax in Cyprus, no wealth tax, no immovable property taxes for properties outside of Cyprus, no capital gains from sale of any goods except property in Cyprus. Now, since the question of domicile is based on your subjective intent, we do recommend reviewing the domicile position with a tax advisor every few years and have the advisor note the review findings on your file.